All right. Good morning, good afternoon, maybe good evening, everyone, depending on where you're joining from. We'll give it another minute for folks to join. And while folks are joining, I'm going to pop up an icebreaker on the screen. So let's see if this works. Here we go. All right. Halloween's around the corner in addition to annual planning. So would love to hear what everyone's favorite Halloween candy is. And if it's not listed, please feel free to drop it in the chat. Looks like we got Twix and Kit Kat tied right now. Ooh, Reese's coming out on top. I wasn't expecting that. Kit Kat still at 7. All right, it looks like it's a tie with Reese's Peanut Butter Cups and Kit Kat. Give it another 2 seconds in case anyone wants to do a tiebreaker. Always interesting to see this stuff. All right. Well, again, thank you so much for joining today's webinar. Really excited to kick this off. We've been doing a handful of these webinars around everything from financial planning to product demos, and this one is going to be an exciting topic. This one is on the topic of annual planning. And so in addition to, as I mentioned, Halloween, the annual planning process might have already started for you. If not, it's probably kicking off very soon. And we have a very special guest for today's webinar, and that is Ivan Makarov. And so I'm going to update the stage with Ivan's bio and pull Ivan to the stage. Ivan is a finance and business operations partner at A16Z. He has a fantastic background, one of the early hires at Webflow, scaling that over the pandemic. Similarly, before that, he was early at Flickr and Smug. And so Ivan has a very interesting perspective on the industry and finance operations as a whole, because he's not only scaled finance operations at these amazing companies, but now at A16, he has a really interesting role in being able to advise and help a lot of the portfolio companies with their financial operations stack. And so, Ivan, good morning. How are you doing today?
Good morning. Doing great. Excited to chat about one of my favorite topics.
We are very, very excited as well. And we also will be joined by Siki a little bit later. I don't know if Siki's on now. Let me try putting him to green room. Let's see. He's having a little bit of internet issues this morning, but let's see if Siki's here. Hey, Siki, can you hear us?
I can. I'm going to drive to a different 5G tower.
Okay.
And hopefully this will work by the time I'm up.
Well, let me just update the background really quickly here. Maybe while we're waiting for that, let's kick it off with an icebreaker. So, Ivan, Siki, as I mentioned, Halloween is coming around the corner. So would love to hear two things. One is, what is your favorite Halloween candy? And two, what is your hope that the audience takes away from today's session?
I'll start and I'll say I'm surprised by the results. My favorite Halloween candy is Sour Patch Kids. Whenever I have 4 kids, so that means we get a lot of candy at the end of the day. And then I go and I apply the dad tax, where I pick up some of my favorite candy. And that, of course, results in a lot of screaming, a lot of negotiating, a lot of authoritism that I exercise. But I usually walk away with a few bags of Sour Patch candy, and I love that. And then the second part is I'm hoping, and we'll talk a lot about this, is that we'll all walk away realizing that there's not a right or wrong way to do the planning. You got to find the way that works best for your business, but that it's also very flexible and one of the key things that we do whenever we build companies. So that's my hope.
Awesome. Thanks so much, Ivan. Siki, over to you. Oh, looks like we lost Siki. We'll bring Siki back on in a little bit as he's sorting out the connectivity issues. But let's just get started. So, Ivan, I'm going to pass the stage over to you. And actually, before we start, just a few housekeeping items. And so we do have a chat. Feel free to pop anything in the chat. There will be a dedicated portion for Q&A at the end of the session. And so if you have a question that comes top of mind, feel free to pop that in the Q&A panel, and we'll make sure to get to it at the end. Second thing, the session is being recorded. So if for whatever reason you wanted to go back and reference the slide material or share this with a colleague, you can visit the same link that you hopped on, and you'll be able to see the recording after the session. With that, Yvonne, I'm going to pass it to you.
Thank you. And again, excited to be here. We talked a little bit about my background, but just to summarize, my role here with the firm is to help our companies build better companies and better finance teams. So I typically work with founders or our finance leaders and finance teams post the check, post receiving the money, and for many years after as they stay within the A16Z family. So as a result, given my background, I spent about 12 years at startups. I've done many planning cycles, probably too many to remember, but they were all fun. And also these days, sometimes when I touch base with some of my former colleagues from these two startups I was at, we ask each other always, what are some of the biggest mistakes that we've made, things that we would have made differently? And almost every time when I reflect back on the mistakes that we've made, it always goes back to, well, maybe we didn't plan for things correctly, or maybe we made the wrong decisions when we were planning. So that is why I firmly believe at the core that what we're doing is we are essentially designing a system with which we will make decisions with which we will course correct. And so I'm a firm believer, and I've just jumped straight into this slide, as one of my core philosophies, not just in business, but in life, is that every system is perfectly designed to get the results that it gets. This is a saying that I've heard when I was still a college student in the business school, and I've been reflecting on it ever since, is that a lot of the times is we don't get the results is because of the design choices that we made. And it's true of the product, it is true of the go-to-market strategy, and most certainly true of the financial planning. And so we'll talk more about that, and I'll refer back to it as we go. But just a little bit about the agenda, how we were planning on doing this. I'll talk for about 20 to 30 minutes about some of the frameworks that I, in my experience, have used for planning, and I've used various different ones. I'll pick my favorite one that I think can apply to any company at any stage. We'll talk about some of the best practices, some of the worst practices. I'll share some of the mistakes that I've made. And then we'll have a conversation about the trends that we're seeing when it comes to annual planning, when it comes to the markets today, and also some of the tools that people use. Fortunately, we're so much better off than we were even 5 years ago, 6 years ago, when the tools for planning did not exist. We'll talk a little bit about the Runway and what they do and what the product is about. And then we'll do a Q&A and answer the questions that you may all have based on the materials presented or just in general about annual planning. So that's our plan, and let's go with that. I'm just going to mention a couple of them, and let's not read this slide, but basically there's going to be a lot of things I'll say today that are my opinion, not necessarily the opinion of A16Z, based on my experience, and people at A16Z may agree or disagree with. And of course, anything we say today is not going to be any kind of financial or tax advice, so investment advice for sure. So, but back to this, it's really the results that you'll get is very commonly, when I look back, is tied to the system that you design them, and it's always worth to think about the design. Those of you that are building startups know this very well. The choices that you make, especially early on, will drive the results, will drive the adoption, and will drive the outcomes of your business. But when you think about a high level, when I step back, and this is something that I think I formed in my head over the years, when it comes to the plan that you have as the business and whether or not company succeeds or fail, it is usually because they fail in one of those three or all three areas of the business. So first, of course, you start with the product strategy and the roadmap, and you think about how we're going to do this and what are some of the choices we need to make on the product side. What's the product we're building? Then once you have the product, or you have the early resemblance of the product, and you have your first customers, your first users, you start thinking about the distribution. You start thinking about how we're going to sell the product, how we're going to make money with it. So you start thinking about your go-to-market strategies and plans. And then on top of that, or in line with that, you come up with your financial strategy and the plan. And this is again, I say it's in the perfect world, because you can get to a very large company size and still not be very good at all three at the same time. But what ended up happening is that planning is often separated into these three sections. Your R&D function, which is your product and engineering, they do roadmap planning on the product. And then you have your sales folks and the marketing folks doing the planning of how we're going to sell this, how we're going to make money. And then you have the finance team, or your outside advisors, or whoever you're using for finance. They're working on the financial plan, the budget, the metrics, so on and so forth that you're trying to achieve. And they tend to work in silos, but in the perfect world, the planning is actually to combine all three and form the plan around it. And so all great companies, and I look at them that have succeeded, they've excelled at all three. Doesn't mean that they excel at all three at the same time. It takes some time, sometimes many years to get there. But then when you have all three really figured it out and you really nail the execution, that is how you become not just a good company, but a great company. And so I always thought of planning as the mechanism that combines all three together, these three separate work streams into one work stream, and a cohesive plan that everybody at the company buys into. The one thing that is fascinating about planning, and my role here, I work with very small companies, sometimes literally 2 people and the dog, and larger companies that could be 100 employees, it could be several hundred employees, and are getting ready to hit the public markets pre-IPO stage. So planning is generally the volume of work that you do and the kind of things that you do and what you focus on is focused on the stage of the company. And the analogy that I often use for this is actually, it's a bit like raising a kid. Those of you that are parents know this. It never gets easier. I was just talking to somebody that just became a parent the other day, and exciting times, 3 months old, and she was telling me how fun it is to have her 3 months old smile back at her, interact with her. But still, there's no sleep at night, and there's all these problems that are immediately, as a parent, I remember. And it's very different now. My kids are teenagers, and I wish I could tell you it's easier, but it really is not. It is always hard, but the problems are just different. And so the problems that you deal with at a startup in the early stage, when you are in that toddler or baby stage, a small company, the problems are different. And then you measure different things, and therefore you design your planning in different ways. And so I came up with this framework that, of course, we'll share with you. But you can think about the stage of the company. You're building the company in early phases when you're just trying to find the product market fit for your company. At that point, all you care about is not running out of cash. And what do you measure? You measure your runway and you measure your cash. As you grow and you reach that milestone, you start seeing product market fit, you start seeing the adoption. That's the growth stage, roughly speaking, let's say $5 million plus in revenue, in recurring revenue or annual revenue. At that point, you start defining your metrics, start defining your KPIs, and all of a sudden you start planning your cycle and your budget around these metrics and hitting those metrics. And then you start reaching scale where you have product market fit, people are buying your product, and how they're buying it, so you have repeatable go-to-market, and you start scaling your company. That is a really hard stage from 25 million to 100 million. This is what I call the teenage stage of the company, where you're still going through a lot of change and you're still doing things for the first time. But at this point, you have established product market fit. And so at this point, you're really building your very robust business model. You know what's working, what's not. So you know which areas of the go-to-market and the product you got to double down, which we should pare back, what's not working. You're starting defining who is our true customer, what's our ideal customer profile. And you start building departments and allocating budgets based on the departments. And of course, once you hit that mythical or the dream of state of crossing 100 million in recurring revenue, a big milestone for any business, Then you start thinking about optimization. Then you start thinking about your liquidity strategy, maybe an IPO, or whatever it is, becoming a business at big business at scale. Then it's all about efficiency, and it's all about the sustainable growth. And so we'll talk about that. So all of those things change, and very highly state dependent. But a lot of the times I get on a call, just literally this morning, a couple hours ago, I had a founder in New York that called me and started talking about the problems where he is still at that build stage, very early on. They don't even have any revenue yet. And I keep telling him, this is a problem for a future you. You're asking me questions that people care about at a later stages of the company. And it was very relieving for him. And so I like to say that a lot. It's a problem for a future you. So think about that when you think about designing your planning. So why to do it? Don't want to spend too much time. I think those of you that are joining the call kind of have a rough idea, and maybe you haven't done planning before, or maybe you've done multiple cycles before and have a lot of scar tissue and experience in this area. But basically, you're aligning the goals, you're aligning the people, you're getting them on board with you, and you want to determine how you're going to track the execution, what you're going to execute on. And again, just back to what I said at early stages, like which we define as seed through Series B, it's really all about speed, simplicity of the process, and then course correcting, because you don't know yet what's working, what's not working. And so a lot of it is like the plans change a lot. At a later stages, it is you're starting to have a 3-year vision conversation, 3-year plan. You balance growth versus profitability, and then you're learning as a business the execution, but you're also learning to beat and raise the expectations every quarter, because that's what you have to do as a public company. I want to spend quite a bit of time on this slide because that is essentially my favorite way to do planning. Again, there are many different ways of how to do it, but it is this 3 or 4 steps process, depending on how you look at it. For finance team, for finance leader, it's a 4-step process. For most of the company, these are 3 steps. The first step is you start with the tops down, and I really don't like the methodology that we use in finance. Tops downs, bottoms up. It's a weird one, but I can come up with a better one. But essentially, top down is what the goals you determine with your leadership team. Usually, this starts with an executive offsite somewhere, and you sit down and you kind of. I like to personal preferences to spend at least 2 days on this. Is when you make the decisions to think about. You start it with what does everybody think about is our biggest challenge or the biggest problem we're facing right now that we want to solve next year. I like to just with one and just go around the room and ask that question. And it goes back to maybe revisiting the company vision. Are we still want to pursue that vision, or do we need to modify it? So you revisit that, you start thinking very, very high level. You start thinking about what are the 3 big bets that we want to accomplish this year. We'll talk a little bit more about that in a future slide. But then once you got those questions answered, you start thinking about other things, like what should the product do? What should be the guardrails around the business? This is a good time for finance to actually play a very important role, because they can give a high-level guidance, a forecast or trajectory or predictions of what the next year could look like from the revenue perspective. And also set some high-level headcount targets. Sometimes you're in a fortunate situation where you have a lot of cash, and it's about like determining how much headcount you want to hire. Other times you're actually in the opposite. The business isn't doing so well, and you need to come to some high-level decisions of what that headcount. Most of the time, at the tech companies, the headcount is the largest expense. And so you can come up with that first hypotheses for what the next year could be like. If you don't know, sometimes in the finance role, you don't know, and there's many different ways you can go. I like to just go straight to the CEO and just ask them, hey, what do you think? What do you think we should be going this year? They usually have a point of view on this. They're not looking at you. They have an idea, and I want to make sure that I agree and disagree with the founder and the CEO early on this. The other thing that I think one of the biggest mistakes that I've made in the past is I waited for too long to talk to the board about this. And so this is why I put that blue box in the very first step of the process. You have the idea, the rough idea where you're going with next year. Ask board for some feedback. And is this in line with what you think we could be going, or how does that sound? Because the sooner you bring them into the conversation, the more helpful they can be, and the easier that final board meeting is. And so I like to do this early, personal preference, but you can certainly do that early in the process before you then get the feedback from the rest of the team. The second step is when you take that direction, take that high level vision for next year, and you take it down the level, sometimes all the way to everybody in the company, and start socializing it, start getting feedback. Here's where we think we're going. Here's where we think we're going to put some of our strategic bets or what we need to build. Here's the rough roadmap and what we think we can accomplish in the next 12 months. Here's how it could impact the metrics of the business. And what do you need? Do you need extra headcount? Is this realistic? We want to build this other new feature. Is it possible to build in the next 6 months? Is it possible in the next 3 months? Start getting feedback, and the sooner you do it, the better it is. Big fan of the owner-operator mentality. Everybody at the company should be an owner-operator of their function, whether it's an individual contributor level or a manager level. But it's important to get that feedback early at a team level. And then once you do that, that process can take a couple of weeks, can take sometimes a month, depending on how quickly you can make decisions, depending on how large or the small is the company. But I think it's a very important step before you go back as a leadership team. You take the feedback that you've received, you share the feedback among yourself. I think what you'll hear from R&D, engineering, product, design org, it might be quite different than what you can hear from the salespeople. Salespeople obviously always want to be ambitious, always want to be generating more revenue for the business, and the same with the marketing folks. And so they'll give you a rough idea of what they think they can accomplish, and so they'll give you their honest feedback to act upon. And so you do another calibration, maybe another executive offside where you just sit back and think, okay, here's what we heard from our people. Here's what we heard from our investors as well. I've been in many situations where we set one target as a company, and we go to our board members and they say, well, we don't think you're ambitious enough. We think you can actually stretch farther. And they end up asking you to think, what would it take? For example, investors love round numbers, right? So if you think you think you could really realistically hit $8 million in revenue this year, they'll say, what needs to be true for you to hit 10 million? What is it to get to 25 million next year? So on and so forth. So you'll have that conversation, but it's good to have it early so that way you can think about what are the possible ways to get there. Or the opposite is true as well. It's unrealistic that what they think you could get there, and so you can have these conversations early, form a lot of data around it, a lot of feedback. And so at this point, you're finalizing in the third step. You're finalizing the budgets, you're finalizing the head count. I like to do the head count. This is a personal preference. I never like to add to the head count. So I set the expectations as a finance leader that in the step one, we determine what the head count could be. Let's say we can add 30, 40 people next year to the team. I just say it before I go to the leaders, to the managers, to the ICs. I like to tell them, hey, by the way, the headcount is only going to go down. It's not going up. We're not going to add additional headcount. So this is the envelope that you have to deal with. So let's figure it out how we split it up. But at this point, you're finalizing. You might be doing the budget. Hopefully, you're doing the budget. And then you're finalizing the company level goals. And the other thing I added there that I think is important is to decide on what are the key moments going to be for the company. Maybe it's a conference that you're planning to do in the second half of the year where you're planning to launch certain features. Maybe it's an announcement in Q2 of we're moving into this direction or we're moving this functionality. Maybe it's the early stage and you're planning to launch a product in June. Decide when these key marketing moments are, communicate them to the company and say, this is what we decided our moments are. And it really helps energize everybody else because they know you have this date. It creates a sense of urgency. It creates the sense of direction, and then people can work backwards from those dates. But I think it's important to have a few key marketing moments. We call them marketing, but it could be key product moments or whatever it is that you're working there. And this is another time to have the calibration with the CEO, with the rest of the executive team, And at the end of the day, get the sign off from the CEO, and the rest of the leadership team owns the execution, but it should be CEO approved. Then the final step, of course, if you have the board, you go to the board, and these are the typical deliverables that we see at the board level, where you do, again, remind them what your vision is, what the roadmap is. Good to present the roadmap and tell them this is what we're working towards and the targets, the timelines. Surprisingly, especially now that I look at a lot of the decks with annual plans, roadmap is not often present there, but I do think it's very important if you're building a product is to show and share that roadmap with your board and know what to expect. This obviously you'll have some version of a financial model. It could be simple, it could be complex if you're bigger, if you have multiple product lines and go-to-market motions, so on and so forth. So that just really depending on your stage and how you're thinking about the business and driving a discipline. And the head count, you'll get the approval on the head count and to say we can hire this much and this is what we're striving towards, or maybe you decide to be flat or do other measures for your business that is in the best interest of the business. And the other important point is you set the guardrails. And guardrails could be around how much are we willing to spend for paying customers, how much are we willing to do, or the sort of the main points around which you're going to keep the discipline at the business. So I think it's important to do this exercise, and that will more than anything drive the execution and also help you keep the score of the business. So some of the best tips to start early. A lot of the companies, I've just been asking this question as I meet with founders and heads of finance, like, have you started? Most of them actually haven't started yet. A lot of companies start early. I think 5 months is too early, is my opinion, but 3 to 4 months before the end of the year is a good time to get into the planning mode. Focus on fewer things. This is also a common mistake. We hear about 5 initiatives. We hear about 10 initiatives that the company is willing to do. I'm a big fan of like narrowing the focus, 3 at best. If I could, this is very hard, but if I could, I'd just have 1. But I've never actually been in a business that had just 1 goal, 1 initiatives. But I keep hearing about it. Sometimes companies decide that they say we're going to focus just on 1 thing, whether it's the 1 specific features they want to ship, or maybe it's like we're going to get business really, really fiscally fit. We're going to focus on the fitness of the business, and we're going to really optimize it. And so the third one is a really if you remember 1 thing, I want you to remember this thing. Do scenario planning, which is you read a lot about this whenever the topic of AM planning comes up. But think about ranges. Think about flexibilities. That is such a huge mistake that heads of finance like me have made before. Sometimes founders, if they say we think this is what is going to be our target for next year. They give 1 number, and of course that number is going to be wrong. It's always wrong. Nobody ever gets really, really close to the pin. You can, by the way, pro tip here, you can have a competition on your team. Who gets the closest to the pin gets some kind of an award at the end of the year. I've heard companies, especially as they're starting to scale, have a sort of a competition of like who can guess the best. But I'm a big fan of the ranges. Range on the revenue, range on your headcount, and range on your cash flow. Here's where we think we're going to land. They can be actually pretty wide. Not all your boards are going to like wide ranges. They'll be like, can you give us a tighter range? We don't like how you're saying there's just the 2-3 standard deviations that are in millions. But create that flexibility for yourself, because especially in this environment, you really never know how things are going to go for the year. And so do that. And then involve the team. I've mentioned that, and the board early. And lastly, course correct. You have that freedom, especially if you're thinking about ranges. Things are going to go off the rails. They always do. Hopefully in the positive way, but most of the time they never go in the positive way. You're always optimistic during planning, but you can always course correct, and all the teams do. You look at some of the best sports teams right now. I have a son that's really into football, so I've been following the 49ers. That is in one of the better teams in football right now. I hope that doesn't generate a lot of the hate comments here in the chat, but they always course correct, and especially the Niners are so good at this. The way they're running their offense and defense, they're switching things all the time. You can see Fred Warner playing defense as a linebacker is constantly talking to his team, and they're changing their defense formation on the go, on the fly, and they're able to stop this. So you should do the same thing as a business, constantly course correct. Key questions to ask. I'll just leave it out there, but these are some of the things you can take a look at. How much time we're spending, who is driving the process. That is surprisingly confusing a lot of the times. Is it the CEO? Is it the head of finance? If you have the COO, should the COO be ultimately responsible for planning? Is the chief of staff? Like this could be really confusing, but decide that early, and that way everybody knows who's ultimately in charge and is on the hook to get the process done. How much do you centralize or you make the decisions at the high level? That's a very cultural question. How much risk you're willing to take this year, right? Is this the year that we're going to put all of our chips in on the table and we're really going to try to hit it? Or this is going to be more of a conservative year, and this is decisions you get to make as an operator and then tell the board about it. They'll give you their feedback and maybe help you influence that decision. But ultimately, you know your business better, and you know your customers better than anybody. What are you not thinking about? These are the things that are very often get overlooked in planning cycles. And what are some of the bigger risks in the business? And of course, as a finance person, those of you in the finance world, in my mind, the three biggest decisions that you make is what's that balance of growth versus profitability? What's the cash fundraising strategy? Do we need to raise money this year? Do we have enough to make it through? Do we avoid raising and just focus on building? And then how do we use the cash that we currently have? How do we fund the business, and how do we spend the money? So I think these are all very important questions. So, sorry, jumped in slides. So now we're going to talk a little bit about some of the trends we're seeing. And like I mentioned, fortunately, I was just thinking a few years ago, all the planning was just done on the pieces of paper and an Excel. And this is how we got to the point where you would see an Excel spreadsheet that comes to the CEO or that comes to the board that's version 47. Fortunately, we're not in that world anymore. There's better tools that are built for this. And so AI has also been really helpful with planning. We can talk more about that. This is now a point of conversation with Siki and I about some of the things we're seeing in our world. Siki, can you, how's your internet?
I am hopefully back. Hello.
Good. We can hear you great.
Yeah, I did an emergency drive to our local cafe. Had a power outage, so sorry about that. But
You're
yeah.
good. Glad you're still with us. So tell us maybe a little bit more about.
I am here.
Yep. I was just going to say, tell us a little bit more about what are you seeing? You've been building in the space for a number of years now, and obviously with Runway, what are some of the better tools? How did the planning landscape changed?
Yeah, there's this tool called Runway. So, I mean, yeah, I'm actually curious what you're seeing in the space. You look at everything, but we think of AI in a very specific way, and there is a ton of hype around usage of AI, and everyone's trying to figure out, well, how can I apply AI to finance? What are the right tools? And the way we think about this is, what probably isn't quite ready yet with the models that we have is having AI actually replace and help you make the decisions for you on your behalf somehow. I think the amount of data that's available and the capabilities of models for reasoning just aren't quite there. The way we think about it conceptually is, if you think about what it is good at, it's good at intuition, it's good at inferring constraints from natural language. And so our use of AI is more about how do we make this as understandable and accessible as possible, and not put it super in your face and not try to pretend that we're going to make decisions on your behalf completely. So, for example, like one really cool thing that we have in Runway, and people don't even know it's an AI feature, but when you look at a model or you look at a formula, we just have a description of how it works and how it's calculated, and it's just text. But that's actually pre-generated from AI, and by analyzing your model, understand. So there's flows of finance. The finance a bit faster and not just replacing the decision-making work.
Yeah, that's really great to hear. Thanks for sharing. Yeah, I'm seeing the same thing. I think there are a lot of I don't think I've ever met a person that actually said, I love annual planning. But but we all do it. We all have to do it. And at the end of the day, we actually love the decisions if we made the right decisions that we've made, and then that drive execution and oftentimes help us to get to these milestones. Again, I'm really big on sports analogies, and I was just fascinated. Whenever I watch the Olympics, I think most of you have watched the Olympics. For me, the interesting part is not the actual race, but the hearing what went into preparation for the race, what went into the preparation of that athlete to be operating and to be executing at that Olympic level. And that's usually many years of right decisions, right discipline, sequencing things. The road to the Olympics is oftentimes 8 to 12 to 16-year-old, old road. And it's the same in running the business. And we do planning exercises, and AI helped us to really get faster on some of the things. Like what I'm hearing now when I ask finance folks, or the founders, are they using AI? Benchmarks are much easier to get to with AI. You can now query earnings releases. You can understand what's happening in the market. For example, if you're building something like, say, Atlassian, or if you're building something like um, any public company you can think about, you can ask the LLM, give me some of their patterns that they recently talked about in their earnings calls. And so that data gets easily surfaced, where in the past you had to have spent hours and hours getting those benchmarks, those ideas, what they said are some of the bigger risks. And so on top of that, scenario planning is getting a lot easier with some of these new next generation planning tools that are emerging, like Runway. And I'm just really excited about the space, because I know the hardest part about this is why the planning sometimes takes more than 3 months than it should take, or more than a few weeks that it should take in the perfect world, is because of all the amount of manual work that you can do. The other thing that's interesting, I mentioned the portion when you actually go down to your team and ask them for their feedback on the plans. You can take notes. You can type them up. You can take notes with AI note takers. Most of us are probably spending time on virtual conference calls on this topic, and then you can summarize them so easily, rather than spend several days trying to come up with themes. And you can just run it through an AI tool and say, what are some of the key pieces of feedback and common things that came up. You get a really nice, beautiful one-pager. They can take it straight back to the CEO. You can take it to your board, so on and so forth. I just this is not the world we were even a year ago, but we are in it today. And so you can make it go a lot faster. And Yeah, these are some of the
Yeah,
things, but I think the biggest thing is just collaboration around planning just got so much easier.
yeah. I'm curious. Like there's everyone's familiar with a lot of existing finance tools, and generally the user experience hasn't been satisfactory in terms of accessibility and making it accessible to people who actually run the business, whether it's product or sales. I'm curious, in your experience in using those tools, what makes it so inaccessible, and what are the things that a product like Runway or some other product could do, or you could change out your process to make it a lot more accessible and loop into other departments in the company?
That's a great question, and I've been thinking a lot about this, because some of my favorite tools that I look at that we invested into, or that we're considering investing into, are not actually built by finance people. They're built by product people. They're built by design people. They're built by people that have grew up, the generation that grew up on easy to use tools like Slack, like Gmail, like Figma, so on and so forth. And these are not the tools that take you very long to learn. And that's why we call them the next generation finance tools, because I've implemented some of the older generation planning tools from bigger companies, and you eventually get through it. It takes you too long to implement, and then you get there, you're excited about it. You know how to use it because you've spent the last 12 months implementing them. And then you give it to your marketing leader and you says, hey, can you give me your marketing budget in this tool? And I don't want to bash any tools, but you have to get on the call with them and spend a week training them on how to actually do the marketing budget. And what ends up happening, especially with I apologize to any marketing people on the call that might be offended by this, but they, at the end of the day, just give you their own template. And they say, nah, you know what? I don't have time for this. Let me just give you my own spreadsheet, how I always done it, and you translate it into your own tool. So you end up doing double the triple the work. Where with these new tools, they can access it very easily because they've been using these new generation of collaboration tools, which is now what we see emerging in the world of finance as well. And they're able to use it, they're able to run scenarios, and they're able to collaborate, leave comments, feedback, build different scenarios. The same with sales, same with R&D. They're able to very easily do headcount planning in the by say pods or functions or product, however you do it at your company. Where in years past it was an impossible exercise. Finance had to be a lot more hands-on. To where now finances just have to sort of herd the cats. Still to this day, this is why I don't know if we're living in the world where FP&A is going to be completely taken away by AI. Any of us that have done FP&A know that that's
Like
the
so.
prediction for people that have never done FP&A. But still, like that collaboration, the level of busy work can be largely eliminated with the new tools.
Yeah, that hits on something that's pretty deep in how we think about it. Like we get asked this question a lot from people who don't do finance, which is, hey, you're kind of like trying to replace Excel. Don't finance people love Excel, and how do you sell to finance people? And if you've done finance before, you understand that like you have existing pains with a spreadsheet, and the real challenge is what is the default for everyone else, right? Whether you're a sales leader or a market leader, or product leader, you have these models, and the first tool you reach for is going to be a spreadsheet. And the challenge there is like if you have your source of truth for the different departments in these different spreadsheets, they're inherently not going to talk to the finance model or just completely add to the workload or be disconnected. And so the challenge I think that is solved, and frankly, like it's a challenge that we're very focused on. I don't think we're completely there. It's how do we make Runway the default tool of choice when you, as a product person or a finance person or a salesperson, have just like any inkling of an idea and you want to try something that is actually a better thing to reach for than a spreadsheet, which is obviously a very tall challenge in terms of design, engineering. But I think that's what it's going to take to make it so that you have one single source of truth that everyone can actually trust.
Yeah, I don't think anybody here would disagree that when it comes to financial data, finance should own the source of truth. But it used to be very difficult when you have 136 versions of a spreadsheet, and you forget that version 136 wasn't actual the version that got presented to the board. Maybe it was 118. And so, and then things kind of get off the rails and everyone's confused what the targets actually are. I've certainly have been there many, many times.
Yeah,
Maybe let's
that
talk a
was
little bit about the.
Yeah, go ahead.
I was just going to say, maybe let's talk a little bit about the market dynamics and sort of growth and profitability, and what we're seeing. I'll just mention a couple of things really quick. Is that it is still a tough environment for most companies that are building in the tech space. There is the AI companies that are seeing, they can raise money and they can raise money fast, but that's a small sliver over the whole ecosystem. For most companies that are building, still fundraising is still hard. There is still much more. We were hoping 2 years into this sort of mini recession in tech, however you call it and term it, that there would be finally a return back to growth. But there's still a lot of conversations that are happening now and the beginning of this annual planning season is that growth profitability balance. It ties back to the fact that money is hard to raise for most companies. And so, in fact, I had one CFO tell me the other day, in frustration, but to him, it feels like they're still being asked by their CEO and the investors, the board, growth at no cost. 3 years ago, we were living in the world of growth at all costs, and now we're kind of still overcorrecting. So there's still some of that is happening. We do see that there's a lot of early positive signs because the interest rates are dropping, IPOs are starting to come back slowly, and more importantly, VCs are starting to opening their wallets again a lot more frequently than they did even a year ago. So there is a lot of the early signs. But this is what I'm hearing. This is what I'm seeing. And Siki, would love to hear what you talk to a lot of the CFOs and the founders. What's coming up for you?
Yeah, there's a tremendous amount of uncertainty, and everyone wants to know what's going to happen next year, and how do you time to fundraising? It's difficult to know. What I will tell you is, I spoke to two different growth stage funds recently, and they told me August was their busiest month in like 3 years in terms of deal making, and so it does seem like it's warming up. And with the forecasted interest rate cuts, let's hope it continues. But it looks like we are potentially entering into a more favorable environment over the next 12 months. But I think, for Runway and many companies that we work with and I've invested in, the default option is you want to plan for growth, but you want to have an option to stay cash flow positive and extend runway as much as possible. And I think in this environment, it is possible to do. We've had 2 years of very harsh discipline imposed on companies, which is a really healthy thing. And now we have an opportunity to step on the gas, and also have a backup option, be conservative. So I think minimally, companies should probably plan for both scenarios.
Mm-hmm. Yeah, absolutely. If you take out all of the AI related premium in the market from NVIDIA and other stocks that are now related to the AI build out, the market is still rough. And so as a result, still plan conservatively is the general advice that we give to our companies, and plan on just assume it's easier to have a wider ranges, to have more grim scenarios in your planning than to expect the growth to accelerate, or if you don't have a very clear path and early hypotheses and experiments are playing out, it is what it is right now.
Yeah, that's a really good point. I think separating out the type of companies is very important. If you look at SaaS multiples minus AI, the multiples have not increased by much over the past year compared to the year before. If you look at the public market, so I think that's very wise advice.
Yep. Just one more thing, because we get this question a lot. Does anything depends on the election outcomes in the U.S.? Most of the experts, political experts and financial experts, says no, because nobody can guess where the election is going to go. It's a twin cost, but as the result, and looking at historical returns, there's going to be obviously some fluctuation in the market based on who wins the election. But at the end of the day, you should never use that and try to guess.
I think the firm has made their opinion on the election fairly clear.
We did, yes. So, but we all have our own different opinions and choices.
Yeah,
so
that's right.
Yeah,
very cool. Maybe it's time to open up to Q&A. We have some questions queued up, so
let's do that.
Most of these are going to be for you.
Let's see.
Awesome. I'll come back on stage here. So we got some great questions that I'll pull up on stage so everyone can see. The first one is from Jeff. And so Jeff asked, what strategies do you recommend to streamline the budgeting process and specifically avoid wish list expenses in the first round of the budget, which can delay the process?
Thank you, Jeff. Great question. I think the answer to this is that is doing more work as a finance team or leader in the beginning. Meaning, you set the guardrails, you say, this is where we think we're going. You have a very clear point of view on what the next year could look like. Again, there's different scenarios, different ranges. But a lot of the times too, we do work with a lot of CEOs that are very financially savvy. They may have been running their business and the model for years before they hired their first finance person. So they'll have their point of view on this, but at the end of the day, I love to have the finance team take the first version of the budget and the growth and the cash range outcome on what's happening with the cash and provide that. And once you do that, you can avoid that long wish list. And like I said, the other tip I have is you do come up with that idea of what you think the headcount is going to look like. Make sure a CEO agrees with this. As a finance leader, you should always be on the same page about this with the CEO. You also get to avoid the trap of finance leaders saying one thing and people bypassing and going to the CEO and the CEO agreeing to another thing. And then you have to say, but CEO told me I can have extra 4 product managers. And then you have to build that into the model. So just always be on the same page, always be talking. I also a big fan of like actually asking CEO in the beginning of the very process, how involved do you want to be? Because some CEOs want to be in the weeds on this. I think we're going to actually see probably a lot more of that post the founder mode conversations and Brian Chesky saying you have to be in the details as we've all talked about more recently. So I think CEOs will get more closely involved in the process, but still sometimes CEOs really want to just be in the product, or they want to be out there fundraising and they don't have time to be planning. And so just get their opinion, how involved they want to be in the process, how if you want they want daily updates. Do they want every couple of weeks updates? I've worked with CEOs that just want to be involved in the very beginning and at the very end ahead of the board meeting, and they let you run the show the rest of the time.
Awesome. And I guess actually you started to touch on this, but there was a question from Robert. What are your thoughts on the frequency of this planning and relevant updates? Is it yearly, quarterly, monthly? Curious to get both of your thoughts here.
My thought is that hopefully it is something you do at most twice a year. So I'm a big fan of like doing an annual plan and then doing an that is H1, H2 plan. And then you get to your month 4 of the year and then you do the H2 planning, which is very light. It's like say 10, 20% of the work that you've done at the annual planning. Shouldn't last more than a week or two, honestly, to recalibrate, to look at the metrics, to say where did things get off the rails? Where are the things accelerating, where they're accelerating, what do we need to do to course correct? Do we need to adjust the roadmap? Do we need to taper expectations? Also talk to your board about this. So that's the ideal world, but sometimes especially in early stages, you kind of have to like look at it quarterly. I don't think if you're doing it monthly, you're always planning, not a good practice. So unless you're about to go out of business, then you should actually probably be doing daily stand-ups if you're like skating on the edge of the cliff. But hopefully you can avoid that scenario early on. Siki, what are your thoughts on this?
Yeah, no, nothing to add. I think I agree with what you said.
Awesome.
You know, it's pretty complete.
The next question I have is from Matt. Matt's asking, what are your thoughts on having finance hand budget targets to department leaders? For example, you get X million for 2025 versus starting with the department leaders, ask for a wish list, and then trimming it down from there.
I prefer that way. So I call them the envelopes as you give people. There's also some businesses that do it on the dollar basis. You say this is what the dollars you get. So you can allocate it between the head counts versus the programs. I think that's hard to do. So I generally prefer to give both. Here's your head count target, and here's your operating budget, which is the dollar amount, and you cannot trade between them both. So, and some people do it, and so it's just really kind of the function of culture and how you want to run things. But yeah, it's best to do that, and then obviously they will have the wish list, and that's where we get sometimes the bed rep to about being that evil grumpy finance guy, and we get the stereotype that way too, is because we have to say no to most things in finance. But no is usually says to these wish lists, and so you got to really figure it out. What are the must-haves? What are the most critical things we got to do as a business? What are the nice-to-haves? I think the wish list, the long wish list, most of the time, you step back, it's a nice-to-have. It's not a must-have.
Great. The next one is from Akram, and they're asking, what's the best piece of advice you have for seed stage startups, pre-product market fit, that are working to get more accuracy into their financial planning process to protect Runway and react to market realities?
Yeah, that is the scenario where you probably don't have enough data. Maybe you just raised your first round and you want it to last 12 months, 24 months, however long. Some founders make the decision. They said, we don't ever want to raise again. And so we want to operate that way. And in this case, you will update your cash model on a monthly basis. Sometimes we do see it that, especially the businesses that are seeing a lot of volatility or they're less than 6 months left of cash, they should really be running a weekly or maybe, like I said, daily forecast. But 13-week forecast is the term for a reason. I think that's a really good window of time that you update it weekly. And so that way you learn, and it's a muscle. It's a muscle that even many of our late stage companies that we invested into is what separates them from being able to go public or not. The business should be predictable. And this goes back to like when you go public, you should be able to beat and raise your expectations for 8 straight quarters in order to sustain that really nice stock price momentum that you want to see post going public. It's really hard to do in practice, so you learn to do it in ahead, but you can do it in the seed stage by just learning, by spending some time. Hopefully, this is also where I often see when I meet with usually the founder, they maintain the cash flow model. It's too complex most of the time. And so if it's more than 20 lines, it's too complex. And so build a simple model, because then every week or every month, you just shouldn't take you more than 15 minutes to half an hour to update. You get your actuals, you reconcile your bank accounts, you look at the major expenses, and then you plot it all in. And then month over month, you can then tweak your assumptions, get to a more accurate forecast model. So I think this is a
Yeah.
perfect use case for something like Runway. So Siki, I would love to hear more about how you do it.
I would plus one to what you said in terms of most people's models are complex. I actually have a pretty clear opinion on this, which is that if you're a CC startup, you should not be using Runway. And you probably shouldn't spend more than a couple of minutes on this. You're pre-product market fit. All of your expenses are going to be in salaries by definition, because you're not making money, you don't have a working product. So first version Runway is actually built for CJ startups, and the pain is actually just not significantly high. If you're pre-product market fit, the thing that really matters is get to product market fit. Otherwise, you won't exist. So I would say, you want to spend your time on the right things, and I think spending too much time on your financial forecast is probably not the right thing to do at the seed stage, pre-product market fit at least.
Great insights. The next question we have is from Tatiana. So what are the examples of the new generation finance tools?
Yeah, so some of the ones that come to mind, Pigment and Mosaic and Veredo are some of the other products that we've seen in the space, other than Runway, of course. And I think what defines these are usually, there's some notion of better design and accessibility. And where Runway is laser focused on is about delivering understanding to both finance, but also people outside of finance. And so there was a question, I think, earlier about how often should you plan, right? And how often should you update the planning? And I thought Yvonne's answer was pretty complete. But as I was reflecting on it some more, I think you should plan like all the time. Like you could plan potentially daily, right? And so we have customers who, for example, integrate Jira into Runway because you want to understand the impact of a particular feature on your financials. And so we think really the opportunity is, how do we make finance something that's not about finance? It's about everyone else and their jobs, whether it's product or sales or marketing and engineering, because everything that everyone does in a company eventually falls down to the bottom line. And so delivering that understanding, unsiloing finance, I think is what defines the next generation products. And I would encourage you to take a look at all of them, including Runway. We're fairly confident in how we shake up there. But those are some other examples.
Great. Well, we have a few more questions. I know we're getting close to time, so I'll go to the next one. The next one is from Josh. For early stage startups, what advice do you have for planning and baking in a buffer for more rare black swan type events, while finding a balance between being prepared for possible extremes at the same time staying focused on the main goals?
Love this question, Josh.
I want to hear Yvonne's answer, but I have to give us a little story. So I invested in one company, and this is an investor update, and they raised $10 million or something, right? And they said, we have $1 million in the bank and we have $9 million hidden, and our runway is only counted for the $1 million that we're counting. And he basically, most of the team thinks that they're about to die, and he has 90% of it in reserves. So that's one way of doing it. I thought it was the most cracked, weird way of doing it, but I thought it was fun.
Yeah, great story. I think that is one of the most common traps, is you forget to build a buffer. And you have to build it in 3 areas. In my mind is 1, revenue. 2 is cash. Likely you're gonna you're gonna have spend more. And 3rd is equity. is like issuing equity if you're running a startup. But my general rule of thumb is 10 to 20% is the buffer, is the TBD, both on headcount, both on everything else, but really especially on the headcount and the cash. You should be prepared for the unpredictable things, like delays in hiring, or maybe you can land that one amazing engineer and executive that you might need to hire, decide to hire, that was not planned. Or like we said, like we've unfortunately in the last 5 years have seen way too many black swan events, and they seem to happen monthly now. So plan for that.
Great. Well, I know we're at time. I'm going to do one last question, and it is from Giada. Hey, Yvonne, when it comes to headcount planning, do you have a preferred source for benchmarking, whether each department's requests align with market data based on the company's specific needs, stage, and size?
Hi, Giada. No, good to see you again. Used to work with Giada. So, no, I don't have a preferred source. I would say CJ Gustafson, my friend, I'll make a quick plug-in for him. He runs a great blog and has a collection of all the latest benchmarks on his blog. That's where I usually go to. There's a new benchmark set, especially this time of the year, that comes out every couple of weeks. So I don't, but I will say, actually, I do. Having said all that, my favorite source of benchmarks and the data and sort of the directions are my own investors when I'm operating. So I can ask them for this. They'll do that work for you. They have better private company data than anybody. And so, and surprisingly, they'll give you some of the amazing insights into what they're seeing companies similar to the size and stage, so on and so forth. And so don't be afraid to use them. Don't be afraid to ask that question. Put them to work. They're there usually for that very reason. And so ask them, of course, consult the other external benchmarks, but your investors can surprisingly be helpful at this. And they always ask, how can I help? And these are perfect questions to ask this time of the year.
Great. Well, Yvonne, Siki, thank you so much for your time and insights in today's session. To the audience, thank you so much for joining. I will send over the recording after the call. And just a little call to action, actually. If you're interested in learning more, we do have this event taking place next week at SF Tech Week. Let me put it on now. And if you're interested in joining, go to tech-week.com and register, and we'll hopefully see you there if you're in SF. Thank you so much, all. Bye.